of homeownership. Sustainability is a big word these days. Sustainable communities, sustainable finance, sustainable homeownership, sustainable mortgage outcomes. And we've got a great set of papers here. And so without further ado, we'll get started. The first one is long-term outcomes of FHA first-time homebuyers. And presenting that paper will be Donghoon Lee from the New York Fed.
Okay, thank you very much. I am Donghoon Lee from New York Fed. And this is a joint work with Tracy, who used to be at the New York Fed when we were working together on this paper, and he has moved to Dallas Fed. So in this paper, we are looking at the long-term outcomes of FHA first-time homeowners. By long-term outcome, we mean we look at their sustainability of the homeownership, whether they are remaining as a homeowner when they pay off the first mortgages or not. And the views, as you know, are my own view and Joe Tracy's view, and then not the view of the Federal Reserve. Okay. So here's the summary. So using better data, so the data we use is New York Fed Consumer Credit Panel that we ourselves created. We report the share of FHA borrowers that led to a long-term home ownership. So if you look at just the loan level data, then you see either default or the payoff. But then you lose where the borrowers, were going. So you don't have a good information, after the loan outcome or the long-term outcome after the mortgage payoff or default. So we argue that the payoff with no default is not the same as home ownership. So that's the empirical question that we are asking. And then we consider outcomes of default and then payoff renter. So then these people pay off the FHA loan, but never again become a homeowner. So that's one of the outcomes. And then remain a homeowner. So we find that we compare the FHA first-time borrowers with other types of mortgages, such as Fannie and Freddie, the VA loans, and other types. And then we find that their performance was deteriorating by up until 2006 originations, and they were performing worse than comparison groups. Of course, this is not controlling for anything else, but then we are just reporting their unconditional outcome. But also we find that since 2007, borrowers, their performance was improving and comparable to other VA and other types. So the data we use is New York Fed Consumer Credit Panel. So many of you might have heard about this one, and many of you might have used this one. So but to just reiterate, so it's a 5% sample of U.S. individual credit data sourced from Equifax. So we created this one around 2010, but then it goes back to 1991, Q1, so it's a quarterly data set. And then we have up until 2018, Q4, and then this is updating every quarter. So it contains account level information on mortgages and student loans, and borrower level information on credit cards and auto loans. It contains location information down to the zip code and census block to track series of borrower mortgage originations. So you basically observe all of the mortgage nations and all of the indication of addresses, and refinance and moves, and then pay off, and then becoming a renter beyond the life of any particular loan. And also it contains payment information such as delinquency, default, and foreclosure, and other types. And important for us, it contains the lender type, FHA, VA, and GSE, and we separately identify Fannie and Freddie. So this is a universal representative account information on all mortgages coming from all types of lending institutions. And then given the long span of the data, it goes back to 1999, and then the 1999 data has some of the past information. So in terms of mortgage information, it goes back to, let's say, early 1990s. So we can create a better measure of first-time home buyers compared to 3-year look-back window, like by FHA and other lending places. Okay, so here are the outcomes of the FHA first-time buyers. So first of all, we see the streamlined FHA refinances. And then for this one, we connect as one, and then we think that this is more accurate borrower level analysis, like in terms of calculating default rate and so on. Because even though the refinanced FHA mortgages constitute as a new mortgage on their platform, but then I think it makes sense to, given that it's so easy to refinance into a streamlined refinance, it would be making more sense to connect them and then conducting analysis based on that one. So one of the outcomes is default, and then which is obviously an indication of not sustainable home ownership. And then the other one is payoff, but become a rental. So by looking at their addresses and the existence of their mortgage accounts on the credit report, we can see whether they remain a homeowner after payoff or they become a renter. So this is an outcome better than default, but not a sustainable home ownership. Okay? And then in the classification of the home ownership, we find different types of people. The first one is stay with FHA loan, like by 2017 and 18. And then there are people who move and originate a new FHA loan. And the last category would be those people who refinance into a non-FHA loan, or they move and originate a non-FHA mortgage. So with respect to the group of these people, so these are some of the basic facts about the first-time home buyers. So among the purchase mortgages, first-time buyer share is about 40 to 50%, which is about half. And then the rest being repeat buyers. And then this rate is about 10 percentage point lower than the FHA definition of first-time buyers, given that they are looking back only 3 years. And then there are people who become a homeowner, and then who become a renter, and then after more than 3 years, they become another, again, homeowner. And among the FHA borrowers, the first-time share is about 2/3, which is higher than the unconditional number, meaning that the FHA loans are a source of first-time home buyers to finance a first home. And among the first-time buyers, the FHA share had a great fluctuation between 1999 and up until now. So it was about 1 quarter in the beginning of 2000s, and then it came down to 10% by 2007, and then up to 50% by 2010. And right now it's about accounting for 30% of the first-time home buyer share in 2017. And then FHA origination credit score distribution improved greatly since 2008 as it began to attract higher credit borrowers. Okay, so I will show you each one by one. So this shows the purchase mortgages. The blue one is the first-time home buyer, and then the red one is the repeat borrowers. And then the horizontal axis is the timing of the origination, timing of the home purchase. So as you see, the first-time share is about 40 to 50%. And then within FHA, the first-time purchase share is about 2/3, and then the rest of 1/3 being repeat buyers. And then this is the first-time purchase mortgages by type. At the bottom, you see the FHA, and then red VA, and then the green Fannie and Freddie, and the other is other. So of note, so some of the one lender didn't have the capacity to report the Fannie and Freddie loan, so the green share is actually understating. But then for FHA and VA, so this is a accurate percentage. And then this is the credit score distribution for FHA first-time borrowers. So up until 2007, there were lots of subprime borrowers with credit score below 560 or below 600. But then since 2008, as it started to attract more prime borrowers, the share of subprime borrowers decreased since 2008. So this is showing the changes in the first-time buyer share measure. So we show 3 of them. So the blue one is the first time ever, like since 1999 measure that we are using in this paper. And in contrast, the red one is following the FHA definition of first-time borrower. We are looking, and by just looking at the 3-year window. And in comparison, the green one is the first-time buyer share conducted by, it's a survey conducted by National Association of Realtors, which is in line with our measure of the first-time ever buyer share. Okay. So I will show you the sustainability scorecard. So in the category of unsustainable home ownership, so we have default rate. So then the default was about greater than 30% for the people who originated in 2006, and now it's less than 10% for the people who originated in 2010. And then interestingly, there are like about 10% of the people who pay off the FHA mortgage, but then become a renter. So that has been stably 10% throughout the period. And in the category of the sustainable home ownership, about 25% of the people, in the 2006 cohort, they stay with FHA loan up until like 2017. So they are still paying down and keeping the FHA loan. And about 10% of the people, they move and then they again originate a new FHA loan. And then the remaining percentage, about 20%, they either refinance into a non-FHA loan during the first home, or they move to a second home and then they originate a non-FHA loan. Okay, so this is summarizing the outcome. So at the bottom, so the blue one shows the default rate, which was increasing of more than 30% and now improving. And the red one is the share of the people who pay off without default, but then they stay as a renter. And the green one is the percentage of people who continue to pay down on their first FHA mortgage. And then the purple one is the people who move to a new address, but then who originate a new FHA loan. And then lastly, the sky color is the people who refi into a non-FHA loan, who move, and then originate a non-FHA loan. Okay, so in comparison, this is not only FHA, so this is everyone else. So as you see, the default rate is lower. It follows the same business cycle, but then the default rate is lower, understandably. And interestingly, the percentage of people who pay off their first mortgage and then become a renter is about the same as FHA borrowers. It's about 10%. So we compare the FHA with other types of lenders, and then we find the sustainability scores, which is the percentage of those people who remain homeowner. For FHA were lower significantly by up until 2006 originations compared to other types of mortgages. But since 2007 originations, FHA sustainability scores were comparable to VA and other types, but not as good as GSE, understandably, and it's improving over time. So this shows the comparison, the finding. So the blue one is the FHA, and then you see the deteriorating outcome up until 2006 origination, and then the performance was lagging compared to VA and other types. But then since 2007, the performance was improving, and then they were in line with VA and other types of mortgages. Okay? And then the summary is the same as I showed you before. And then using better data, then we can look at the outcome beyond within the loan, and we can look at the long-term outcome of not only FHA but other types of loan, including Fannie, Freddie, and VA, and so on. Okay, and then that's it. Thank you.
Good afternoon. So this paper has done what previous papers haven't, which is linked borrowers across loans in order to find the long-term default rate or sustainability rate of loans. And for that, it's very interesting. It's a short paper, and so I don't have 10 minutes to say about the paper. So of course, I'm going to talk about something else instead, but that relates to the paper. Here's what the paper does, and in his comments, Donghoon didn't talk about this, but it gives a brief history of FHA. And in this history, it sort of implies that it lost its way when it started allowing lower down payments. And there is about 5-6 pages of the history of down payments of FHA, and then a discussion of defaults of FHA, and then the data work. And I think there was sort of a linking between one thing and the other, though not explicit. And I have a problem with that linking, and so I'm going to spend a little time talking about that. Again, the data exercise is well done. There's really not anything to criticize. Well, I'm going to have one little criticism. Because it borrowers, not loans, take into account internal refinances, and that makes all the sense in the world to me. Argues that FHA should have a target level of sustainability. That's reasonable, but it never says what that target should be or why. And it treats both default and return to renting as failures. And this is the point at which I have a criticism on two dimensions. First of all, the renting dimension is not necessarily a failure. So if you move from one city to another for a job, and you make a or retirement, and you make a transition to renting for a little while, I guess it's not technically sustained homeowning, but I don't see why that's a policy problem. The other thing, and this may be a nitpick, but the definition of returning to renting is when you move, there isn't a mortgage associated with your move. That's how they define that you're a renter. And as it happens, when my father-in-law died about 6-7 years ago, my wife and I inherited my in-laws' condominium. We didn't move into it. We actually kept it so my parents could live close to us. But the point is, that is a way one could easily acquire another house and move into it and not have a mortgage recorded, and particularly if I'm an FHA borrower, that might be an appealing thing to do. And given that about 10% of their survey, or their sample, are these people who, I will say, moved to a place and didn't have a mortgage, if 2% of them fall in that category, I don't know what the percentage is, but that would be a decent amount of that. So I'm not crazy about if you're not really a renter, but a person who moves to a house, pays off her loan, and doesn't have a mortgage, that somehow that's treated as not sustainable. And so thinking about that more subtly, I think, is key. Here's what it doesn't do. So I want to see more implications from this paper. It doesn't compare unconditional outcomes between FHA and other programs, which is to say, suppose Fannie and Freddie just don't make as many loans to first-time borrowers in the first place, and we know that they don't. Okay, let's go to an extreme, and Michael, no, I know F&F make loans to first-time borrowers, but let's say they made no loans to first-time borrowers, and all their loans were sustainable. Well, that still doesn't help first-time borrowers. So even if your sustainability rate on FHA were 60%, and that was the only source of lending to first-time borrowing, maybe that's the best we can do. So some kind of context there, I think, is critical. And the reason this is particularly important is if you look at mortgages purchase money mortgages to African-American households, they are overwhelmingly FHA mortgages. When I was working in the government, fewer than 3% of Fannie and Freddie's purchase money business was going to African Americans. About 7% of all homeowners in the U.S. are African Americans. Where was it coming from? It was coming from FHA. So I think this sort of explicit comparison is important. Second thing it doesn't do is compare with subprime lending in terms of sustainability, which I think if that's the alternative you want to look at. And third, consider why VA does so well, even with zero down payment loans. And this comes back to a statement that a Fannie Mae executive made to me in 2009, I'll never forget, he said to me, is our Las Vegas book is so terrible, our default rate is 35%. And my reaction was, that's a miracle. Your default rate is only 35%. Because house prices in Las Vegas fell by 70%. Okay, let's think about FHA loans originated in 2005 and 2006, or VA loans. By 2007, they were essentially all of them underwater. Because, and I have a graph that I should have put up here, if you look at every housing market in the country, although Lori showed a picture of Indianapolis where it looked like it was pretty flat, but in nearly every housing market in the country had at least some depreciation. So if you have an FHA loan and you're financing the upfront mortgage premium, you have like maybe 2% equity in the house, so a year later, you were upside down. So in light of that, kind of did okay. They kind of did pretty well, right? But, so here's the, so I just took a screenshot of your graph. This is the sustainability scorecard, and if you look at 2006 and 2007, here are the defaults, here are the renters, and your overall default is like 30%. Default plus renting is 45%. Given that everything was upside down, maybe that's not so bad. Okay, remember Fannie and Freddie had plenty of stuff on their book that was 20% down payment or more, so they had lots of stuff that was not upside down, whereas all of this was upside down with double-digit unemployment rates in many parts of the country. But what's striking to me is compare this to VA, and I should try to do this at the same scale, I didn't, but VA, we look at 2006, 2006, the default rate is like 20%, 2007 less than that, so just go back here. FHA is 30 and 28, VA is 20 and 18. So VA did 30% better, something like that, than FHA did. And the down payment on a VA loan is 0. VA loans have upfront premiums of a little under 2.5%. Should always, what is it, 2.25, I think? 2.15, that often gets financed into the loan. So you're talking about, they're all upside down too. And they did a lot better. So I think in thinking about sustainable homeowning, trying to figure out what is the secret sauce that VA has. Maybe veterans are just different and then we're kind of can't learn a lot, but maybe not. That is something that would be worth looking at. So I actually thought strong performance, the relatively strong performance of VA here was a really interesting thing to look at. Finally, we're talking about issues with FHA. I can't help but talk about its original sin and where issues of sustainability may be coming from. There's a terrific paper from 2 years ago that I commend to anyone who's interested in these issues, which I think are the people in this room and about 30 other people. By Ernst and Hartley and Mazumdar that uses sort of difference in difference order discontinuity design to look at the impact of redlining maps from 80 years ago on 3 things: homeowning, home values, and credit in different neighborhoods. And what they find is there are still legacies from those decisions made 80 years ago. And so if we're really thinking about the obligation of FHA to make homeowning sustainable, thinking about how do we undo this really terrible thing that was done now is something that I think we have to think about. The other thing about, I think this might have, and this gets to the VA thing, is implications for the mortgage insurance premium. Is one of the things that the crisis taught me that really surprised me is that equity is not everything. Lori did some runs for when I was in the administration that looked at conditional on whether you've always paid your loan, whether you're upside down or not. Are you any less likely to pay your loan in the next period? And there was a tiny difference between the two groups. You know, sort of once you paid for 5 years on time, you could be upside down, you'd still continue to pay. But what we have seen is that programs that provide payment relief, like HARP and HAMP, actually were very effective at reducing defaults. Okay? Now, there's a debate over what the mortgage insurance premium should be for FHA. Okay? For VA, there's a one-time upfront premium, which is about equal to the sum of the FHA upfront premium plus a one-year premium. It's actually a little less than that. And then you pay no MIP on VA, but you continue to pay 85 basis points on FHA. And VA does better. I got to stop there.
Hi everybody, so I'm Carpenter with the Atlanta Fed, where I work in our community development department. I just wanted to quickly recognize my colleague Lisa Nelson in the back row, who's one of the co-authors from the Cleveland Fed, and then Taz George, who is not with us today, from the Chicago Fed. And of course wanted to thank the organizers, Fannie Mae and JCHS, and this has been a great program so far, so I'm really interested to learn even more. And of course, I do need to give the disclaimer that these remarks are my own and not those of the Federal Reserve Bank of Atlanta or the Federal Reserve System. So the paper that I'll be talking about today is really work that we've been undertaking for about a year, looking at land contract or contract for deed sales. We've been focused on 6 Midwestern states. You're going to see why when we get into the data that we used. But we undertook this research really in light of a new national database on land contracts that was advertised that we went ahead and purchased in order to follow up on some of the past studies, including studies that we'd done at the Atlanta Fed that really had to focus on kind of smaller scale analysis or looking at individual sellers of contract for deeds. So we were trying to open this up to a wider universe and a wider geographic area and the impacts on communities of contract for deed sales. So it probably would be helpful for me to just briefly define what a contract for deed is, what we mean by this. And the most basic definition is really that it is a type of seller financing. It can have a variable set of terms associated with it, but one of the things that they have in common is that the title is not conveyed until the last payment is met. So this is one of those less sustainable or less secure forms of homeownership in that the buyer can really have a number of kind of problems or situations where they are forced out of the home for various reasons. And we'll go through some of the examples of how that works in various types of land contracts. However, and they do also offer really all of the responsibility of homeownership, maintenance of the property, the need to pay property taxes and insure the property without any of the rights or protections of foreclosure procedures, or any some such. And also they lack the protections of renters as well in states where landlord and tenant protection law is a little stronger. That makes a big difference. But they could appear to be on paper advantageous or a viable alternative for a low-income borrower who has poor or no credit. What we'll see, I think, in some of the data is that the purchase price of these homes tend to be very low. Sometimes the monthly payments are quite low, and of course fees and transaction timing and costs tend to be a little bit lower as well. However, with the caveat that there are a lot of pitfalls to this type of homeownership. And unfortunately, there's really just not a lot of data, so that's why we went ahead and purchased this data set and did this not quite national, but kind of regional analysis of a number of areas in the Midwest. The recording requirement of contract for deed sales varies state by state. Only about a quarter of states have any kind of reporting requirement at all, and you'll see some of it in our maps that is not enforced quite accurately. So we really don't have great data. And then finally, you may have read some of the recent reporting from the New York Times, Matthew Goldstein, Alex Stevenson, Ta-Nehisi Coates in the Atlantic. Contract for deed sales are getting some renewed attention, and they sort of had their heyday, if you want to call it that, in the 1970s when there was communities in Chicago that were experiencing redlining and blockbusting, and contract for deed sales kind of came in as a way, unfortunately, for equity stripping among speculators in neighborhoods there. So around that time there was a lot of attention, and we're kind of seeing this reemergence of attention And one of the reasons for that is this slide I'm going to show here, which is a number of corporate sellers of contract for deeds have emerged. And first to note from these kinds of entities like Harbor Portfolio and Vision Property Management, they tended to buy a lot of properties in bulk from foreclosure sales, so from Fannie Mae and also from HUD. And they purchased many of these homes at only a few $1,000s, and then went ahead and kind of flipped them as is at several times that purchase price. This is a typical contract that Harbor offered. This is from the National Consumer Law Center, who's done a lot of great work and advocacy around land contracts. So what you see here is that this particular contract, and I don't mean to overstate that all land contracts kind of fit into this exact bucket, but this is one of the reasons why this drew a lot of attention, this practice. They tended to have, in Harbor Portfolio in particular, very high interest rates, 11%. The title wasn't conveyed until after the final payment. The down payment and the monthly payment were quite small and actually in line with or a little lower than rental costs in some of the neighborhoods in which they were sold. But there was missing information, to be kind, in these contracts that led many of the buyers to actually believe they were engaging in a mortgage when they were not, including documentation that used the word mortgage, for example. They were sold in as-is condition, so that meant there was no inspection done. That meant that in some cases copper wiring was completely removed. There were appliances that weren't working, roofs that needed repair. So the stipulations of the contract required the buyers to bring the homes up to habitable condition, in some cases in a few months. And so those are enormous upfront costs that were not disclosed to the buyers. And other things in the contract could lead to the forfeiture clause being enacted, and that's another piece of Harbor's contracts in particular that raised alarms. And so if you miss one payment, if you fail to maintain the property or bring it up to habitable condition, to properly insure it, a number of other things, you could be evicted basically, and all of your quote-unquote equity, it's not technically equity, but any investment you made in the property, including your own sweat equity or your own improvements to the property, completely lost. So again, without the protections of a mortgage holder or a renter. And this varies a little bit state to state, but overwhelmingly there's not a lot of protections for these buyers. So one of the other things that kind of encouraged us or was an impetus for doing this study was that we really just don't have national data. We don't have great coverage of even some local areas to track the issue. So the last known kind of national survey data is from the American Housing Survey. They actually removed this question from the survey in 2009. So while we have a few data points, as you can see here, and in 2009, a little less than 5% or 3.5 million homes were financed with the land contract. We don't have data for, of course, the recession itself or the recovery period. So that's, the kind of, in light of the reporting that we've seen more recently, this is the era that would be of most interest. But you can see a slight decline in at least the AHS survey data over the time period that's available. Also additional studies that we conducted at the Atlanta Fed and some of the other researchers and journalists, news outlets engaged in, were really dependent on property records. So kind of searching out owner names of sellers like Harbor Portfolio. And one of the challenges with that is that they were often divesting or spinning off companies or changing the spellings of their names in different ways. Perhaps not on purpose, I can't say that, but it made it really difficult to track where those properties were and to find them even in our large-scale property-level databases that we have access to at the Fed. In other cases, folks were able to scrape individual county records, which is great if you want to look at one particular region or area, but very difficult to do at a larger scale. And then in some cases, in particular in the colonias, Heather Way's group in the Contract for Deed Prevalence Project did a great survey project, but of course that required extensive resources to pull that off. So when Adam Realty Track at the time advertised this national database, we were very curious and followed up to get more information and ended up purchasing it. We went through some give and take with them to try and make sure that we were getting the most recent version of the data, all of the appropriate data points, and so we really didn't get the final data until a little less than a year ago, actually. And even at that point, we found that we had data coverage issues and data quality issues. There's a lot of noise in the data. And I should say that this graph on the right is an example of an area in my district, Jefferson County, which is where Birmingham is, where we were able to do some county scraping of records. And we found, even though there is a reporting requirement in Alabama, the percentage or share of land contracts as compared to homes with a mortgage was extraordinarily low, much lower than the 5% that you can see that we saw in the national data. So again, just to drive home the point that enforcement can be very uneven locally. So here are the data that as we got them in the final delivery. These are counts of contract for deeds over about an 11-year period, so 2005 to 2016. You can clearly see that we had better coverage or a larger number of transactions in 6 Midwestern states, and that's really the area that we chose to focus on. And actually about 25% of all the records ended up being in Michigan and 72% in those 6 states in particular. And that is really because they have not only just a reporting requirement, which again Alabama also has, but they have more local enforcement or maybe more of a culture of actually recording the properties themselves. So that's how we decided to kind of hone in on those 6 states, and being in the footprints of our Federal Reserve districts, that made a lot of sense, and also that being contiguous. Washington State is another area that we might end up finding a way to study, or maybe with some of our partners from the San Francisco Fed, because they also had a fairly sizable number of records. So then when we kind of drilled down a little bit, geocoded those data points, a few of them dropped off because data on the address field was also kind of spotty. We were able to see that there were interesting spatial patterns going on. So obviously you can see where there are some counties that have major holes in data. There are big white spots, like in Wisconsin in particular, and then clusters kind of in an island in middle Michigan, where one county in particular had quite a lot of contracts recorded. So at that point, we knew that we would have to probably refine this a little bit more and set cutoffs for which areas we were able to analyze based on data availability. And again, these are all, the contracts themselves are recorded at the county level with, it kind of depends, registrar of deed or the county clerk, different agencies, and that's one of the challenges that we found. So we did set the threshold you'll see in our neighborhood model that I'll present in a few slides. We did set a threshold of at least 500 recorded transactions per county in order to do more kind of neighborhood scale analysis, because anything less than that over this 11-year period, just it didn't seem like there had been much of an effort at all to do reporting. I'll show a few descriptive statistics before I try and get through some of our model data. One of the things that we wanted to look at was really the change over time, and this is just in the sheer numbers of contracts that were recorded. You can see that this kind of tracks with that previous slide from the American Housing Survey, so that there was kind of a downturn from 2005, a little bit of an uptick in 2009, and then since we have more data points after that, we can see a plateau really during the recession and then a drop-off during the recovery. So there's a few things going on. I mean, homeownership rates have clearly dropped. Headship rates have been plateauing or declining. But also it would appear you might be able to interpret this as contract for deed sales tend to decline in terms of volume and kind of periods of growth, possibly. Another thing that we found on the right-hand slide, or right-hand graph in the slide, is that most of the transactions that we had in our database were sold by a seller that really only had one transaction in the database. So they were a one-off seller, maybe a mom and pop, sometimes under a person's name rather than kind of an LLC or a corporation. And that really made up the bulk, about 69% of all contracts in the database. And that tracked with some previous data that we had done. So those Harbor portfolio and Vision portfolio, they do account for thousands of transactions. But in terms of numbers of sellers, they're really the minority share of what we're looking at in this kind of activity. And then in terms of the value of the properties, they did tend to skew lower, and you'll see a little bit more data on that in a following slide, the median home price was only about $72,000. And there was a wide range, so we did have a number of properties that were just a few $1,000s, and then we had kind of a cluster of properties that were $500,000 or more. So there's certainly different instances or different housing markets, it seems like, where this activity is going on. And then in terms of interest rates, they, again, ran the gamut. The median was 6% there, so lower or higher, I'm sorry, than prime, but much lower than that 11% that we saw in the previous slide looking at a typical harbor portfolio transaction. But I should say, again, the range was quite wide, from 0% up to 50%. Shocking. And one of the things that we looked at was kind of the value of these properties pre and post crisis or pre and post recession. And what you see here are the bars represent shares of contract for deed sales that are kind of in relation to mortgaged homes or cash sale homes, very low or low value, so less than 75% of that other type of transaction value. So in orange you see for mortgaged homes, contract for deeds before the recession tended to be actually lower in comparison to mortgaged homes, and that value rose quite a little bit, up to 63%. And then for cash sale homes, a larger percentage of contract for deed sales pre-recession were actually, a larger percentage were in that lower value category than post-recession. So really what we're seeing is that the values of contract for deeds are falling relative to mortgaged homes and rising relative to cash sale homes. And perhaps more interestingly, we did another exercise where we looked at HMDA lending histograms versus contract for deed lending histograms for Wayne County, Michigan for 2 periods. You can see here that the contract for deed sales price is skewed much lower. Not a lot of overlap, but I'm going to have to speed up a little bit. I just got the 2-minute warning. And then once we got to 2016, that gap actually tended to increase, so there was a larger skewing of low-value contract for deed sales prices in 2016. So there certainly is, because of the lack of overlap, there may be this kind of piece of the market that is not being accounted for in traditional mortgage lending. And I probably don't have time to go through the neighborhood level model, so I encourage you to read the paper. But what we did was look at block group level data for the 99 counties that met that threshold of 500 contracts or more over the 11-year period. We incorporated a lot of demographic, socioeconomic factors into the model, and we ran this model in 2 stages, one with just those factors, and the other including housing market kind of indicators like vacancy, homeownership, age of structures. And we found mixed results here. We did find that the model with more of the demographic characteristics performed quite similar to what the literature would make us assume. And then when we added in those housing market characteristics, the relationships shifted quite a bit and were not quite what we expected, but the neighborhood characteristic indicators were quite significant in the model and performed as we expected. And we did have county level neighborhood fixed or local fixed effects in the model as well to account for those major differences in things like state law and local reporting policies. And just to make sure that I don't overstate the kind of lack of data around how these contracts are affecting low income, in particular African American households, these are some of the quartile level descriptive statistics, and you can clearly see a pattern where first quartile being the areas where there were the largest concentrations of contract for deeds certainly had the other side, the top 10 percentile certainly had the lowest values, lowest median household incomes, and highest percentages of African American residents. Can I have just 90 more seconds?
I'll give you 90 seconds.
Okay, thank you so much. So I think I went over all the discussion points. Certainly it's very difficult to track this issue. We feel that gap in low dollar mortgage lending is really leading to maybe some of these contracts being undertaken. We do see mixed kind of results in terms of demographics, but based on previous work and This being sort of rather different than the work previously looking at corporate contract for deeds in particular, we think there are more questions that this raised about different kinds of housing markets across the U.S. We did have, this is the first study I think I know of that looked at both non-metro and metro markets together, so there was some differences there. Policy interventions, there's certainly a lot of state law that's been forwarded, and in some cases model law in places like Ohio and Texas, especially to require recordation. Local law, Youngstown and Dayton have been doing good work to do things like requiring a certificate of occupancy to make sure these properties are habitable and to kind of eliminate some of the blight. There's certainly some federal areas where certain agencies can step in. Legal services legal aid has been a really great resource for helping to bring forward class action lawsuits against some of the sellers. But I think my big takeaway on the policy side is that we just need viable lending alternatives for these households at this level of income and in these distressed housing markets. So thank you. I'm sorry for going over.
So this is a fantastic room, and I'm glad to be part of this conference. Thank you, Chris and Michael, for the invitation to be here. Thank you, Anne, for the chance to read a really interesting paper on a topic I think we should all like to know more about. I'm speaking for myself, not for anyone else. I'm going to start my thoughts by just reflecting on a little bit about what a land contract is. Now, in one sense, it is seller financing. But if we take away from that just means that the source of funding is different, that it's from the seller, I think we're missing some important things that are actually going on here. So I'm going to make the case that this is fundamentally different from a mortgage in two ways. So first is the nature of the transaction itself. In a typical mortgage scenario, you're going to have two transactions that occur at basically the same point in time. The borrower is going to incur the loan, they're going to get the funds, and within minutes or maybe an hour if it's a long closing, they're going to get title to the property. They're going to walk out of the room with both of those pieces in place. In this situation, what we have is one transaction that tries to fulfill both of those functions over a long period of time. So you're going to incur an obligation as a consumer, and you're going to get in return a promise to transfer title when you've satisfied that obligation. Now, if this sounds like the kind of technical detail that makes first-year law students bang their head into a book, you're right. But it's also something that turns out to be enormously consequential. It's enormously consequential for homeowners or for consumers' ability to build and tap into equity through home equity lending, for their ability to sell their home and move when they may need to for employment or for other reasons, and as was discussed by Anne, to recover their equity in the case of default. They're anything but typical. They vary enormously across the country. I'm showing you one excerpt up here of just what one land contract looks like in Minnesota, but they even go by about 10 different names. So whether it's a deed for contract, a land contract, a deed for bond, there's just not a lot of consistency among them. I'm going to argue that they're unlike a mortgage in another fundamental aspect, which is the changing constellation of the parties involved in the transaction and their interest, and the consequences that has for the dynamics of what happens and what consumers experience. So in a typical mortgage scenario where a lender's involved, they're not going to be there by themselves. They're going to have their supervisor, their licensing agency sort of looking over their shoulder, accompanying them. They're going to have loan underwriting that goes along with that. And they're going to bring in an array of actors to protect their interest, to ensure that if there is a default, they can seize the collateral and sell it to satisfy the obligation. So that's going to mean there's going to be an appraisal involved to make sure the value's there. There are going to be inspections to know that the property is fundamentally sound. And there's going to be clean title so that the property can transfer. Why? Because the lender is not exposed to any of these risks and would very much prefer not to be. In the case of a land contract or a contract for deed, the seller already is exposed to all of these risks. So their incentive to have funds in the transaction go towards mitigating these risks are just sort of fundamentally different. And so this context has enormous implications along these lines, but also has implications along the kinds of protections that apply to the transactions. Some because of the nature of the transaction, how it's changed from a mortgage situation. So for example, bankruptcy protections are less clear for consumers who are involved with a contract for deed than they are in the case of mortgages, but some also because of the nature of the number and kinds of parties involved. So on Anne's last slide, she had a sort of a reference to TILA there, and TILA, in the case of most mortgage transactions, is going to apply. So you're going to get your mortgage, you're going to get a standard set of truth in lending disclosures. In the deed for contract, that may not be true, not because truth in lending in principle doesn't apply to these situations, but because it doesn't apply if you have a limited participation as a seller of these instruments in the market. And so the vast majority of instances covered in the data that Ann talked about are not going to be subject to truth in lending disclosure requirements. And so that's going to change the nature of the transaction for the consumer as well. Now, why do we have these instruments? I mean, they're just so foreign, I think, to most of our experiences. All I can really say is there are good stories that you can imagine that talk about why we may have these instruments, and there are not so good stories. And at least in the literature, the not so good stories appear common enough that we should all want to know a lot more about what's happening here. So I think one of the nice things about, I think probably the nicest thing about the work here is that it's taking advantage of the data for a very good use. A lot of the studies here in this area have been done by identifying firms that tend to trade in this paper and cataloging their activity as sort of a proxy for land contracts. It reminds me a little bit of how we used to identify subprime loans in the last century. Thanks to the good work of the folks at HUD, we had sort of the subprime lender list, and we were able to look at activity in the marketplace and sort of derive some understanding of the amount of lending that was happening, but that gave us a huge sort of selection bias in terms of what we were able to see. Thank you, Whitney. And here, they're not relying on the firm identification, but they're able to go to the public records themselves and use that to see that 84% of all the sellers just had one transaction, 99% had fewer than 6. Why am I calling out 99%? Because 6 is the threshold for activity for being covered by truth in lending requirements. So you can see virtually none would be. I take a look here at their descriptive statistics. I'm just preparing, looking at some of the ratios between the areas with a lot of activity and the least. And as you can see, and as Ann described, sort of concentrated in communities that are disproportionately minority in composition, with lower college attainment, lower incomes, lower home values. Their regression models essentially come in and say, and all of this is largely a function of the communities where these populations live. So they're living in housing, in distressed housing markets, and as a result are sort of more exposed to these contracts. In the paper, they don't take a run at sort of the distribution of actual consumers receiving these contracts. I think that's something you can do. You have the name, you have the geocoded information. You could look at Bayesian improved surname geocoding that's used in the fair lending context quite often to take a look at trying to come up with some estimates of the population receiving these mortgages. You could use information from the Social Security Administration to look at the gender of the recipients of these instruments. I think that both would be pretty interesting, and in combination with the geographic information could sort of paint a fuller picture. What else did we learn? We learned about a variety of the land contract attributes. My one caveat here, and I'll say it a little bit more on the next slide, there are a lot of missing values in the data, and so I think you have to look carefully and try and think about these as whether these are truly representative, but they're more information than we have from any other source. They look at them as a potential response to a market gap, sort of have up a version of this slide that Ann had showing sort of the disproportionately low value nature of these products. One question in my mind, though, is that some of these are so low that it raises a question of whether they're really purchase transactions for the entire interest in a property. Could they be transfers between family members? Could they even be refinances of prior land contracts where a balloon payment was due but the borrower couldn't come up with the funding? At $5,000, $10,000, $15,000, properties do transfer in that range, but that's such a small value that it really raises questions for me about what are we seeing in that data. That's not an inconsequential proportion of instruments that are down in that range. It's sort of non-trivial. So I'd encourage sort of a little bit more look there to see if we can understand particularly those low value transactions. My caveats, property records are difficult. As somebody who's had numerous meetings with vendors selling property records, they are incredibly optimistic about what you will get out of their records. But when you get in, you start to worry about the noise and the challenges of working with the data. And so Anne didn't describe it, but really the authors here have done tremendous work to sort of cross-reference their data with other data sources to try and fill in holes and try and corroborate what they're seeing. I think that's admirable. At the end of the day, we still have to recognize that the data is being collected and categorized out in courthouses by the vendor staff. It's a challenging thing under the best of circumstances, and we should sort of take all these measurements with that in mind. And then the selection issues are challenging. You talked about sort of enforcement. I think about it as adherence, but even in the geographies that have a lot of reporting, the experts seem to say that non-adherence prevails even there. So there are selection issues, and I have 1 minute. So I'll just say we need a lot more high-quality data in this area. This is the elephant. In the past, studies let us see the trunk. This is letting us see a leg, but we still don't see the elephant, so we need a lot more data here to understand this. And particularly, I think survey data could be helpful. I don't know that even the AHS did a great job of capturing this activity when it asked about it, and so we can do a lot more. And I think that data should drive our considerations of what policy should be improved, how we can introduce protections in ways that allow some of the good stories to continue. And I think, I'll just say, if we think about these protections in our sole frame of references, how can we have protections that make them more like mortgages? We're likely to miss the mark. I think we have to think about how they're different in kind than mortgages. Some of that conversation at the beginning of my comments, and the data should help us do that. And I also think this points towards thinking about how we can open up access to mortgage credit to sort of alleviate some of the stress here. Realistically, a product that primarily is going to serve the needs of low and moderate income consumers. It's going to be hard forever, I think, to reach a level of comparable protection to what we experience in the mortgage market. And so I think it sort of behooves us to think a little bit more. One of the takeaways is about access to mortgage credit and the role it could play in sort of decreasing the take-up of these products and getting people in a place where the incentives are maybe more aligned as well. So I'm at 0, maybe minus 0. And thank you all. I hope that wasn't too fast.
While he's putting that up, I'm Jeff Zabel from Tufts. Unlike Richard, he just left, as far as I know, none of our coaches have taken bribes to let students in.
Everybody was thinking it. You didn't have to say it.
I really want to thank Michael and Chris. I mean, the audience here is fantastic. I mean, this is #1 schmoozing conference, right? Right? And if you do get a chance to schmooze with me, and I hope you do, and you notice the coloration around my left eye, I'm just going to give you the answer because you're going to want to ask, did you get into a fight with this black guy? And the answer is yes. I got into a fight with a barbell. I was doing a bench press and I didn't rack the bar correctly, and it raised my eye. I think there's no long-term effects, but if I start to act erratically, and I know that's hard to identify in a class of a group of academics, let me know.
Nice story. You said something about it being in a bar?
So, 2 other public service announcements. One, I help run the Greater Boston Urban and Real Estate Economics Seminar. We meet twice a year. We give 3 papers each time, and if you'd like to be on the mailing list, let me know. One other thing, I really want to congratulate Harvard on their big victory in basketball yesterday against Georgetown in the NIT. So that's a big victory. So I guess I'm going to talk about stress from low-income households.
You can keep talking about basketball, that's fine.
How's your team doing this year?
Never mind.
Okay, let's see. So, we've been talking about this belief in the U.S. that homeownership is the American dream. This is one of my favorite graphs of all time that I put together. It goes back to 1890. This is the homeownership rate in the U.S. And you can see that it was about 45% or so, and then we had this big jump between 1940 and 1960. And then, we've been pretty stable after that. So I like to think of that, and this is a paper on the back burner with Lynn about the natural homeownership rate. I think our natural homeownership rate was about 65%, and then we had a failed experiment where we tried to get up to 70%, and now we're back down to 65%. So it's not at all clear that everyone should be a homeowner, right? There's a number of reasons why the government should get involved in the homeownership market. You know, from efficiency standpoints, there's positive externalities that we think go along with homeownership. There's information asymmetries that we can improve upon. There's discrimination in the mortgage market. And then finally, there's this idea that homeownership is a means for wealth accumulation. And it's particularly important rationale for addressing this huge disparity and differences between homeownership rates for low and high income homeowners. Now, the government claim that this is the only way that low income homeowners can accumulate wealth. And in a previous paper with Wainer, who's in the back there, we wanted to find out if this is really true. And then it ends up, as some of people have been talking about, it depends. So we ran 2 horse races. We started with a bunch of renters in 1984, and we looked at those that purchased homes in 89, 94, 99, and looked at their wealth accumulation relative to the renters who didn't purchase. And we found out, in fact, that low-income homeowners can actually accumulate a fair amount of wealth. And what's key here is that this was in a market that was relatively stable. Now, we also looked at a horse race starting in 1999 and followed a bunch of low-income renters who became homeowners, and basically they didn't get any wealth at all, right? It went up, and then we hit the downturn, and they ended up with no wealth accumulation at all. So this idea that low-income homeowners can't accumulate wealth it's really it's not so simple. If the market is volatile, maybe not. If the market is relatively stable, there seems to be evidence that we found that there is potential for wealth accumulation, and I would think that going forward, this is more likely to be the case than the volatility we saw recently. So what I want to look at now in this paper is looking at the last 10 or 20 years is why haven't low income homeowners been able to accumulate wealth? And one reason that I'm going to focus on here is this idea of homeownership duration. And the data show clearly that low-income homeowners just don't hold on to their homes long enough. That their durations of homeownership are much lower, and if they can't keep their duration, their homes, they're not going to be accumulating equity and accumulating wealth. So I want to know what explains this differential in homeownership duration between low-income and higher-income households. And I'm going to end up estimating models of homeownership duration behind in mortgage payment and foreclosure models to look at this. I'm going to use the PSID. They have tons of questions on demographics and housing and wealth. And I'm going to look at 2 samples. One that starts in 1999, and the PSID is now biennial. And I'm going to look at another one that starts in 2009. And the nice thing about this sample is this is when this mortgage distress supplement was added to the PSID, and it has all this great information about homeowners, the types of mortgages they have, their interest rates, whether it's fixed or adjustable, and also whether they're behind in payments. So I'm going to use that data as well. So the first sample, I'm looking at households heads aged 25 to 54 in 1999. I have 4,408 households, and I'm going to divide them into 2 groups, ones that were owning in 1999 and ones that were renting. And I'm particularly interested in the ones that were renting, and I'm going to break those down into 2 groups. The ones that actually purchased a home during this period, this is the R2O. Then there's always the ones that always rented. I'm particularly interested in this R2O subsample here. So these are renters in 1999 who ultimately purchased a house going forward. So I can follow their duration, and I know when they start their duration for home ownership. The second sample again, what's going to be key about this is including this mortgage distress information on mortgage characteristics, whether they're behind in payments and foreclosure. I also got access to the proprietary PSID. What that gives me is the census tract. And I'm going to link in data from the census so I can get information on neighborhood quality. I'm also going to link in data from the FHFA, and I can get zip code level house price data. So I can also use that to look at it, when they buy their house, is it in a neighborhood that's been showing increased price appreciation or not? It's also the case that the information on home equity is self-reported. There's a bias there. I'm going to use this FHFA data to calculate my own measures of home equity based on the rise in prices at the zip code level, rather than using the self-reported home equity. The key here is low-income households. I'm just going to look at the first quartile of the income data in 1999 and in 2009. And I'm going to distinguish between the low-income homeowners and the higher-income homeowners in this case. So what do I add? What I'm really adding here is I've got lots of data, lots of things about what could be affecting homeownership duration. I've got household characteristics, including income. I've got these trigger events. There's this, so whether there was a change in employment, whether there was a change in marital status or health, and I've got this exogenous measure of home equity. I've got this neighborhood quality data at the census tract level. So that, a lot of people have said, well, what's wrong with low-income homeowners, why they can't keep their houses? They buy into low-quality neighborhoods that are showing, less price appreciation. Well, I can look at that and see if that's true. And I've got, I've also got county-level unemployment rate that people have used as proxies for these trigger events. I have the mortgage characteristics, type of mortgage, interest rate, monthly mortgage payment. So I've got all of these characteristics to kind of look at what seem to be important in driving homeownership duration and behind in mortgage payments and foreclosures. So I'm going to estimate these models, fixed effects and random effects, and I'm going to break the moratorium on no Greek letters. You ready? Here it is. Oh, no. Here, no. So first, I want to show you this. So again, one idea is if we look at duration, there's the first thing we notice is the shorter durations of these low-income homeowners. Again, this is what I was pointing out before. So we can see this is this R2O group, 14 to 16 years of duration. It's about 15% for the low-income group, and it's about twice that for the higher income group in terms of duration for that length of time. So I'm also going to look at this. I can look at this double hurdle hypothesis, right? That the idea is what caused. There's two necessary conditions before people give up their homes. There has to be negative equity, and then there has to be this trigger event combined together. And I can look at that. I can test that hypothesis because I got the data to do that. So here are the Greek letters. Here's my equation, right? This is it's a home ownership duration model. It's funny because the left-hand side says rent, right? But it's a one, it ends in a zero, right? So it's a duration model. And I've got change in real income, I've got change in health, change in marital status. Again, these are these trigger events. And I've got home equity included as well. I've got the unemployment rate at your county level. I've got these baseline household characteristics like age and gender and race. I've got these census characteristics that I'm going to use to measure a neighborhood quality. I've got the house price growth rate in 1999 baseline and household fixed effects. So I can run this as, to get something that is plausibly causal here, though not quite obviously. A census variable, so I started out with a whole number of census variables. I actually pared it down to 13. Here they are. What's going to end up happening is I throw these in the model. None of them are really significant. So I just use a principal component to kind of get the maximum variation of all these variables that I'm including in the model. I'm going to do this by random fixed effects. I'm going to limit the sample to first spell for homeowners that switch to renting. I'm going to do this for high and lower low-income households. So what are the significant drivers? In the random effects, I find these 2-year House price growth rate at the time of purchase has a negative impact, so the p-value is not great. So there's some mild evidence that low-income homeowners are buying in kind of low house price growth neighborhoods to begin with. For higher income households, females and African Americans are more likely to transition to renting. And here's another key thing. These are for higher income households. Higher wealth holdings have a negative impact on transition to renting. So there, again, this is the idea that what causes the higher rate of transition is the lack of wealth on the part of low-income homeowners, and I find some evidence here that kind of backs that up in terms of this higher income having this extra wealth that can tide them over if they have a negative event, like a trigger event. So what drives both of them, the one trigger event that matters is the transition from married to not married. The other ones, change in unemployment, change in health, don't seem to matter. This one seems to matter quite substantially. The other key thing is the change in real income, right? And this is what I'm going to interact with whether or not they're in negative equity. And I find this result, that there's a really strong effect on transition if you're in negative equity and you have a loss of income. So this is evidence of this double hurdle hypothesis. I'm going to skip this. I'm going to go to the next sample. Again, and the key here is the mortgage distress supplement. So here's just some information on this data. This is homeownership rates. They kind of go up. Well, they start high. They kind of go down, as we know, because of the crisis. And they end up at about 55%. The variable rate mortgages, they go down over this time period. And behind in payments are also going down just because the market's improving. The same thing is true with foreclosure. We can see, and again, the one thing to notice, it's a very rare event, foreclosure in the data. So these are the interest rates. We can see that the variable rate mortgage is a little bit below the fixed rate. Those that have home equity, positive home equity, it's lower. Those behind in payments and foreclosed, not surprisingly, have higher interest rates. Here's home equity. Again, this is not in foreclosure. We have a positive average. Those in foreclosure, negative equity on average. Here's another equation with Greek letters. The dependent variable is either going to be a binary behind in mortgage payment or in foreclosure. I've got a fixed rate, variable rate mortgage indicator. I've got the real mortgage interest rate. I've got monthly mortgage payment and home equity, house price growth rate as well. What matters is for both cases for both behind in mortgage payments and foreclosure is for low-income households. It's the size of the monthly mortgage payment that matters in terms of making these households either foreclose or behind in mortgage payments. For higher income households, it's having a fixed rate mortgage. That actually decreases the likelihood of being behind in mortgage payments or foreclosing, and the interest rate itself, the real interest rate. So what does not matter is neighborhood quality. It just doesn't seem to matter at all. So there's a number of papers that argue that this is potentially the cause of this, buying into low quality neighborhoods. I don't find that in this data though. So that's kind of an interesting negative finding, I guess, for these results. So what's also interesting is that the percentages of instances of negative equity and the trigger events and annual income loss are not very different between the low and the high income homeowners. So, yet low-income homeowners transition to renting at a much higher rate. So what's the difference? The difference is the wealth effect, right? That the higher income households have greater wealth holdings, and so when there's a trigger event, they have something to fall back on so they can keep making their payments. So that is the result, one of the results that I found that we've been talking about. Again, the higher income households can rely on their wealth to get them through these tough times. Not the case for low-income homeownership. And you know what's kind of the catch-22 here is that we want to have low-income homeowners own their home so they can actually accumulate wealth. So when there's rough times, they're able to rely on that. But they can't hold their homes long enough to be able to accumulate wealth that they can use to keep them from transitioning to renting. So there's a real catch-22 here that we need to think about. And finally, it's not enough to design policies just to get low-income households to home ownership. We have to keep them in their houses. We have to keep them, owning so they can actually build up wealth that can tide them through the tough times. So, what could we do? We've been talking about some of these, reduce the monthly mortgage payments for low-income homeowners, or maybe, backload these mortgages so that there are lower payments to begin with, that they might increase over time, giving them more time to stay in their houses and to build home equity. Thank you.
I'm Sasha Killewald. I'm in the sociology department here. It's my pleasure to be able to talk a little bit about this paper. As we heard in the first panel, there's a lot of discussion and a lot of evidence that at least in some circumstances, homeownership can be beneficial for wealth. And something I like about this session, and especially this paper, is it sort of takes us a step back to say, not looking at homeownership to wealth, but who has access to homeownership and what forms of homeownership. And in particular, something I like about this paper is that there is research on access to homeownership, but more often it looks at the direction into homeownership, which is great. But I think sometimes that focus on hazard of entry into homeownership has blinded us to thinking about exit from homeownership as potentially not just the mirror image of entrance in, but maybe having its own set of determinants. So that's one thing I really like about this paper, is it foregrounds a type of housing transition that I think has received less attention. So one of my suggestions is just to really lean into that part of the paper. Right now, I think in both the paper and the presentation, there's a lot at the beginning about wealth accumulation. But the paper's not really about wealth accumulation. I think hearing your story of how you came to this project is very much motivated by that question.
I need to change my title.
You
Get
should
that
change
out
your
of that.
title minimally.
Completely.
And I think it'll help the reader
Yes.
kind of focus a little bit more. I also think that it'll give you some space to really engage the somewhat small number of papers that do exist on the determinants of exit from homeownership, many of which were written by people in this room, and sort of use those analyses as the grist for the mill of articulating the unique contributions of your paper. So the paper takes up a lot of questions. What explains shorter homeownership duration for low-income households? Differences between high and low-income households and the determinants of homeownership, exit, whether mortgage traits, adverse events, and negative equity play a role in these exits, and what role neighborhood traits might have played in the race gap and the foreclosure crisis. It's all interesting, and I bet that in the room we have people who are interested in different parts of that, who are most fixated on different sets of results. A challenge is it's a lot. So my biggest comment is I think this paper is 3 papers trapped in the body of 1 paper. And I think that...
If he wants to publish 3 papers, I'd be happy.
Right. So sometimes it was a little hard for me to keep track of what the most important takeaway was. Now my sociology sweater is going to be on, but the thing that I enjoyed the most was the double hurdle hypothesis idea, in part because despite being a good demographer, I kind of like a little bit of theory, and I thought that was the part of the paper that had this sort of interesting theoretical idea to pull out, and I would have liked to see even more of the development of that theory. So what's the argument about how these adverse effects and equity should interact? And I don't care whether it's sociological theory, by which we mean chatting with words, or whether it's econ theory, by which we mean math that's not related to reality, like your pick. Either one is fine, but I think that would just help the reader kind of buy in a little bit more to why this is an important theoretical question to take on. And I think also that there's some interesting questions about what the different mechanisms for these different adverse effects is. So as a family demographer, something I was struck by is that marriage and exiting marriage matters for both groups. And part of me thought, well, right, one part of exiting a marriage is your financial resources go down. Another part is you can't both live in the house, right? So somebody has to exit, perhaps just temporarily, But there might be a rental period for somebody for kind of purely family disruption reasons, even apart from financial. So for me, it would be super interesting to hear more about what's the mechanism, what's the role of these different pieces of the puzzle, and what can we learn about homeownership stability through that. Another question I had about the double-hurdle hypothesis is, what's the theorized role of the shocks versus the levels? And so, one thing, like, what is the role of a decline in your income versus just being consistently low income? Does the model really hypothesize a distinct role for the shock, or would being kind of persistently cash-strapped have the same effect? So this is the same kind of thing I think you could draw out a little bit more. The way that I think the many ideas plays out in the results section is, again, there are a lot of both descriptive and sort of regression-based results. And I think that, again, it can make the reader a little bit overwhelmed. What's the sample decision? What's the modeling decision? Who's in the sample? Who's out? Why were these different decisions made? And so for my money, I kind of prefer the hazard duration models. I don't think you're getting as much leverage out of the rent-to-own, own-to-rent descriptive patterns, although again, that might be something that could be drawn out in a totally separate paper where we think of these as kind of qualitatively distinct groups. By focusing the analyses also on a smaller set, I think that would also give you the space to draw out in more detail, the robustness of the analyses for those core arguments. So you talked about it here, I think, that the coefficient on home equity goes in the wrong direction for the low-income group. Is that right? That positive home equity is positively associated with exit from homeownership for the low-income group. And you flag this in the paper as an anomaly. And I just wondered, is that a true substantive anomaly, or is it maybe a specification issue somewhere in the models? And you couldn't, in the current paper, you couldn't possibly investigate that because you have so many results already. But I think if you focus these out into several different papers, you'd have more space in each one. So I'm going to pause there, end there, but just say super interesting paper. I think each one of these sub-papers will really thrive given more space to grow.
Okay, if we could have the presenters down on front, please.
Okay. That's good to know.
See, is this on? Is this on? Yeah. Okay, I'll take the prerogative of asking a few questions to start with. Again, one for each panelist, and then we'll take some questions for the audience. Starting with Donghoon to my left. I was a little unclear whether you're able to really observe borrower mobility or whether it's strictly credit usage. So are you really able to tell from the credit reports, per se, whether someone moves to another residence?
Yeah, so there is this address information attached to each credit report. So if someone is moving and changing the address associated with any of the mortgage or credit card or anything, then we would be able to pick up the new address. And then from the change in the address, then we can infer the true mobility of the borrower.
Okay. And again, we can't tell, though, if they're moving to a new address for a cash purchase, or I guess we can because they would be at a new address without a mortgage.
Right, so in those cases, where the borrower moves and then buy the property with cash, then in those cases, then we would misclassify the move as a rental.
And for Ann, since this is a session on the sustainability, do you have any way to measure forfeitures of properties through land contracts to determine to what extent homeowners acquired properties but then lost them?
That's a good question. So I did write down a data point from Heather Way's work in the Colonias, and what she found in these, this is an area Texas has had some reform around contract for deed, especially on the reporting side. She found that less than 20% of the deeds, and this was between 1989 and 2012, were converted to, or the contracts were converted to a deed, and about 45% were canceled. So I don't know how generalizable that is, but that was pretty startling data. But it may be something that I thought about this too, it may be something that we can do by combining a couple data sets, or possibly, basically by combining, I think, some of the data sets that we already have access to with the land contracts data. So it's a good question, and I think something that we could potentially explore.
Okay, thank you. And for Jeff, just if I may, one point, you showed that slide of homeownership falling until 2013. It is going up again now over the last couple of years, so there is some recovery, and I just wanted to make that one point, but then ask whether your results, to what extent are your results driven by the effects of the Great Recession? As I understood it, you have observations where there are exits from homeownership in other time periods too.
The duration model goes 99 to 2050. So, I mean, the reason for focusing on this area, this time period, and you're correct, if I could have had, I could look at the earlier time period too, where there was actually a stable market and see how the results compare. That could be interesting. But I was particularly interested in this period because this was a period when low-income homeowners were not able to accumulate wealth, and I really wanted to look into why that's the case. But it could be interesting to compare it to the previous time period.
Okay, thank you. We'll take some questions now. Yes, in the back there.
Hi, I'm Rachel Siegel. I'm at the Future Trust. Oh, thank you. I have a question for Ann Carpenter. Do you have a sense of what housing types were most prevalent in the land contracts? I'm thinking specifically of manufactured housing, but any other insight on what exactly, what kinds of homes were in there?
Yeah, again, this is something we may be able to explore by combining various data sets. So I don't want to give too much attention to the corporate sellers, but those were the properties that we were able to do a little bit more background research on, getting actual copies of the contracts, but also doing kind of Google Street View analysis and just kind of looking at the type of housing stock that they were interested in and investing in. It was, and then from some of our data, I think we found that the average maybe age of the home or year built was something like 1950, 1960. They tended to be modest homes, maybe 2-3 bedrooms, 1 bathroom, and in, again, kind of sometimes previously middle-class neighborhoods that had sort of had more disinvestment in recent eras, but sometimes pretty low-income areas. But like I said, I mean, I think I mentioned that on the upper end of the spectrum, we had many houses that were being sold, and we did some vetting and found that these were legit contracts being sold for like $500,000 and above, and that was something I was so curious about. I did pay money to pull some of those contracts from a couple of counties, and you know, they had pretty large square footages, 8,000 square feet, things like that. And they were in suburban areas. I think that was like the Royal Oak area of Michigan, so a pretty upscale suburb. So I think it still does run the gamut. And then when I was looking in Birmingham, I would say that there was a lot of very poor quality housing stock that was sold by the one-off sellers rather than the corporate sellers. So properties being sold for like $4,000. And when I was looking at kind of street views, these were, I mean, I don't even know how to, it's shacks, essentially, just really poor quality, substandard housing. So, I mean, that's not an exact answer, but I think it is something that we could potentially explore in the future.
Mr. Ryan?
Hi, Doug Ryan, Prosperity Now. Jeff, I have
two questions for you, if I can. One is on, you talked about exiting home ownership for low-income, low-income homeowners. One question, I'm wondering if you looked at the age of when they became homeowners? Because
Yes.
you did?
Yes.
And what did you find? What was the,
Not much.
that didn't impact anything?
No.
That's interesting, because one reason why I brought that up is because we all know, there's lots of good data that African-American homeowners become homeowners much later than white homeowners. And of course, the earlier you're a homeowner, the more likely you're able to deal with the volatility of the market. So I was just wondering if that had a factor, but that's interesting. It's good to see that that was looked at. The second thing is more of a comment, but you talked about policy prescriptions or approaches to maintain home ownership. And I would want us to talk about servicing, mortgage servicing, and I'm just putting that out there. For example, there's a lot of private, servicers are out there who have, and Fannie and Freddie have protocols and all that kind of stuff. But the mission-driven servicers, CDFIs, the HFAs that do their own servicing now do a better job, and they also serve this market that we're talking about. And I do think there's lots to be learned from mission-driven servicers. They have more, they're higher touch, they're in there earlier, and those kinds of questions. I do think that's something that has to be raised a lot.
Over to you.
I could just start if people can hear me. So this is a sort of combined question for Ann, huh?
Introduce yourself.
Oh, sorry. I'm Anna Jefferson. I'm at Apt Associates. So this is kind of two questions for Ann on the paper that I thought was really fascinating, and I really appreciate you bringing it to the conference. My interest was in hearing more about the buyers who are on the buyers of the contract for deed properties. Both wondering if you can look at buyer characteristics, and possibly not, but I would love to see some follow-up work maybe on buyer characteristics, their motivations and their experiences with the land contracts. And I wonder if these buyers, especially in areas where sellers are, the large sellers are doing a lot of post-foreclosure contract for deeds, if these might be previous homeowners who have been foreclosed and are trying to get back into homeownership when they're locked out because of it showing up on their record, or they've been through a bankruptcy. And so I'm interested in what their experiences and motivations are that sort of transcended your comment about it being a withdrawal of mortgage providers who are doing the smaller dollar loans.
Yeah, so on the first question, the buyers themselves, you're right. I mean, I think Keith raised a great point that there are some other data sets we can combine to look at things like gender, maybe income for the buyers. Race and ethnicity, yes. So I think we'll explore that. But yes, for this we use neighborhood characteristics as a proxy, which has some problems associated with that. But I would say if you're interested in learning about the experiences of the buyers, and this is mainly in the corporate seller arena, there are a number of complaints that have been filed against Harbor and Vision Property Management. One is by the Wisconsin Attorney General. Another recent one was by the Pennsylvania Attorney General with testimonials from these buyers that are heartbreaking. There's also been a package on the Cox Media put together with a bunch of local news affiliates where they interviewed folks who, again, thought they had a traditional mortgage. They were deceived in many ways by, I think mainly that they focused on Harbor, and just the issues that they'd had with property maintenance and the quality of the housing. So yeah, I mean, I can follow up with you and give you some examples from those stories, but they're really heartbreaking. And then on the other side of folks who had experienced a foreclosure and are maybe trying to get back into the homeownership market, were you saying in the actual same property?
No, I mean, not
Okay.
necessarily the same property.
Gotcha. Yeah, I mean, because that would be a target buyer, someone who has low or poor credit. That's a good question. This is something I've been thinking about a lot with when we talk about wealth building and we're going into a kind of potentially a new phase in the cycle for real estate. There are winners and losers from the last phase, and what are we doing for those folks who had a foreclosure or a short sale and we're hitting the 7-year mark, and is there outreach to kind of help them rebuild and to let them know that maybe this isn't the right time to buy if they're interested in re-entering. I'm curious about that kind of question too. But no, I don't really know if the folks who are buying these properties, I mean, I think in some of the news reporting, there were folks who maybe grew up in the neighborhood and were interested in actually transitioning to homeowners based on the community roots that they had, which again is very heartbreaking because this isn't a stable way to do that. But yeah, I'm not completely sure beyond that what those trends would be.
Stephanie?
I need the microphone or? So quick question for Donghoon or thought. And so I think what Richard pointed out about not knowing what to do with the people that transition out of the mortgage essentially, so we're not sure that they're transitioning to become renters. I wonder if you could look to see what the distance is. So you have the blocks, right? So I'm wondering if you could look at the census block and look at the distance. So if they're going a far distance, we might just be expecting they're moving, maybe they're renting now, but they're doing that for mobility reasons for work. I think you brought up like it's a job, it's an employment-based thing. So if you see a far versus, if they're just moving in the same area, then you might expect they're just, school district doesn't, that would be good, yeah. So that could be one idea to try to tease that out. And then the other idea would be, and maybe you've already done this and I missed it, so the duration of the rental spell, so do you see that they eventually have a mortgage again? So you have a good panel of data that you could look to see, did you check that out? Or is it just once you go to renter, you're classified as going to renter? Or do you let them come back? I mean, could you create another, I guess, I'm just trying to tease out that renter group, that group that's transitioning to renter, because I don't think it's a funky group. It's not all bad, it's not all good, but you might be able to say more about them by teasing out the how far they move and then looking to see if they ever become mortgagers again, because it could be a divorce situation then where you become a renter and then go back into.
So for the first question, we haven't looked at distance of moving, but I think that's something we can look into.
Yeah.
It's a great question. And then for the second question, we look at the entire duration after paying off. So the chart that we showed was based on the 2000 at the end of the 2017, whether they are renting or owning a home.
Okay.
But then we can look at some of the different outcomes based on 5 years apart and 10 years apart and so on.
Yeah, cool.
Thank you.
The gentleman behind Stephanie. Can't read your name tag.
I'm Max Vespers. I'm in sociology at Rice University. I'm a sociologist, even though I'm not wearing a sweater. My question is for Jeff. Could you describe a little bit more of the decennial census variables you use to construct your neighborhood quality? Because you said neighborhood quality has ended up having no effect, and that would be surprising, and it certainly is very surprising to me. So if you could unblack box it a little bit, I'd be curious.
Let me see. So, I mean, I started with 30 variables, all from the 2000 decennial census, and there was just too many to put all at once. So I narrowed it down to 13. So I had poverty rate, I had average household income, I had percent Hispanic, percent Black, number of households, whether you moved in the last 5 years, and a few others in there as well. And when you do, there's just too many. So I did this principal components, and you could see the way it weighted in that was a measure of neighborhood quality. So it gave positive weights to household income, negative weights to poverty, to come up with this one measure. That even that measure didn't really have much significant impact on homeownership duration or behind in mortgage payments or foreclosure. I mean, I did a lot of work to get that there. You kind of hoped that it would actually show something, but it didn't, and that was a little bit shocking, because there's a lot of papers that say this is one of the reasons why low-income homeowners end up defaulting or whatever, because they just buy into low-quality neighborhoods, and that hasn't been that.
Right, I mean, it's certainly the case that it's shown neighborhood quality for lots of other housing. I mean, foreclosure, right, is one that neighborhood quality is super predictive of. And so homeownership exit, it'd be interesting to sort of think about what mechanisms are more or less different than these other forms of leaving a particular household, physical household, and why neighborhood quality would matter for some but not others.
I mean, one thing is that not, most of the papers that do that don't have the number of factors that I've included in my model, so they may just be picking up something else, right, that I'm able to account for in my study.
I think you found that exit from marriage was a very important factor.
That was the one of the trigger events that seemed to matter.
So I'll just share some inside information from Fannie Mae, and that is that it turns out that number of borrowers is one of the most important factors in terms of loan performance. So when you go from 2 to 1, which is probably what you're getting in that situation, you would think that effect would occur, right?
Ray Boshara, Federal Reserve Bank of St. Louis. To your point, just 2 comments on Jeff's paper. One regarding family structure. There's been great research, I think, on the relationship between family structure and income. Brad Wilcox and Bob Lerman's paper, I think, is important. But there's been very little work on the relationship between family structure and wealth. And I propose that for future research, perhaps, something I'd like to look into. It's a tricky thing for the Fed to study family structure. Might need some outside help. But the second comment is I think Jeff's paper really underscores this relationship between short-term stability and long-term asset accumulation. Maybe that's obvious, but I think this makes the Patricia McCoy's paper even more relevant here, that if you don't figure out a way to provide liquidity and buffers for families to get through some crisis, it really imperils not only their short-term stability, but their ability to accumulate wealth. And if you do that within the product, or you do it outside of it, I think that matters less. But I think it just really underscores the significance of that relationship and the connection between these 2 papers.
Did you want to react to that comment, Jeff?
Thank you. No, that's me too, yes. And that's kind of what I was saying in my paper.
Right, no, it's just, I wanted to underscore it.
Yeah, thank you.
Mark?
Mark Schroeder. In your paper caused some people to be curious about buyers of the contracts. I'm curious about the sellers, since you say they are overwhelmingly just one contract per seller. It suggests that possibly most of them are not pros, that they are probably most of them not speculators or real estate professionals. I'm wondering if you can say anything about them. I'm wondering if some of them are not allowed to do a short sale because they can't pay off the lender, or if some of them inherited a property that they can't get rid of otherwise, or there's something else happening there.
Yeah, that's interesting. We really were focused on kind of just determining corporate versus non-corporate, but I think you're right, there's much more to uncover there, particularly, like you mentioned, so many of them selling one property at a time, at least in this 11-year period, does not make you a pro. But I worry about if it is a property they inherited, that they're then selling as a land contract, that they could be lacking clear title to that property. It could be tied up as heirs property, for example, meaning that it's owned in common by a number of tenants in common who are the heirs of the previous owner. So I think this is a great area of inquiry that we may consider looking at for sure.
Chris?
So I wanted to follow up on Richard's comment about the fact the paper, Donghoon's paper, in the paper you talk about the fact that FHA doesn't have a benchmark for sustainability, and you end up coming up with a measure of that. And Richard pointed out that you hadn't opined about how one might think about what that benchmark should be. So having written the paper, I guess my question is, have you thought about that? And I guess, and from two different points of view, we typically think about it from the lender's point of view, which comes out to a financial calculation. There's a way to think about it, given FHA's role in terms of from the consumer point of view, what that benchmark should be. And I'm actually going to rebound the question back to Richard, given your role, and see have you answer it. And Richard, see if you have an answer to that question as well. Am I allowed to do that?
No.
Oh, yeah. So I think the FHA has the home ownership stability as a kind of mandate in the establishments, but then we were thinking that we didn't find any of the benchmark directly coming from the FHA. So given the availability of the information from the data we created, then we were thinking that we could provide some information that could be discussed and followed by FHA and other institutions. But then we don't have a particular standard or the benchmark such that the benchmark should be. But then we were thinking that creating some kind of benchmark for any form would be interesting and also encouraging the answering discussion.
Okay. Richard, do you want to pass the question?
Well, so Richard Green, USC, I'm owning it. Some of you may be reading about us in the papers recently. I think you need to figure out what is the cost of failure. How much harm does it do households to fail? So we know a default does produce a reduction in credit scores, and that has real consequences. Versus the benefit of being able to Pat's point, take advantage of leverage and get these returns that are comparable to stock market returns while and having forced savings and so on. And until we figure that out, I'm not sure how costly a failure is. Until we know that, it's hard to say what the benchmark should be, but the paper sort of leads you down this. They say they should have a benchmark.
Right.
And so, okay, let's come up with a benchmark.
So let me just jump in on one point. A couple people have mentioned that the IRRs that Chris came up with were, looking good relative to stock market returns. It's a false comparison because that's a leveraged rate of return.
That's right.
And the leveraged rate of return should be much higher than the unleveraged rate of return. And very few people hedge funds obviously use leverage in the stock market, but those returns we talk about are unleveraged returns. Yes.
Gary.
Yes.
Hi, I'm Rocio Sanchez-Moyano. I'm at UC Berkeley. I have a question for Anne. Given that you have so much data on the values of these properties, what is your sense for how many of these could be viable financially from a rent-to-own perspective? So something that's more regulated on the rental side and that looks like a rent contract, but comes maybe with an assumable mortgage or something where you can be building equity sort of through the rental spell without the same sort of loss in exit in a deed for a contract.
That's a good question. Yeah, I think I would have to look at some of the models, like the self-help model of responsible lease purchase. Yeah. Yes, and I do agree that the way that those kinds of contracts are generally structured includes things like housing counseling, building your credit up, all these different mechanisms to ensure a more stable transition and more sustainable form of homeownership. So I think that's an interesting question. I would say we took a pretty rough pass at looking at values for this paper, given the timeline and everything, but I like your idea, so thank you.
Sir in the back. I'm sorry, I can't read your tag. Okay, Gary.
Gary Engelhardt, Syracuse University. Anne, I really enjoyed your paper. Anne and Lisa, I really enjoyed your paper. I think it's been something that's been greatly understudied. I do believe there's really two stories going on with land contracts. There's a metropolitan story and there's a rural story. And these are really two completely separate types of housing markets. the type of narrative that we hear when we talk about housing is a narrative like Richard Green, right? Richard said Las Vegas. He didn't even need to explain how much house prices fell in Las Vegas because we all knew, right? Or if I said Boston in 1991, right? Many of you who've been here that long would know exactly what I was talking about. But what if instead I said Crow Wing County, Minnesota? Would anybody know what that meant or where that was? But that's one of those places, yeah, Richard would. That's one of those blue counties on Ann's map. And it's a rural housing market. These housing markets are ones that where traditionally land, agricultural land and other land was sold by land contract. They have a culture, they have a history. And in places like Crow Wing County, which is where I grew up, it's not unusual to have these things. So the question is, there's a little bit of a historical overhang. Now, in the data that were presented, those are not historical data. And so this idea that this is really kind of some, this is a part of the market that somehow otherwise wouldn't qualify for kind of standard mortgage products, I think is really well taken. But one thing to think about in these rural housing markets is that the housing transaction value is very low. So it would not be unusual for a house to sell for $40,000. $40,000, that's not half of a bathroom in Boston, right? I mean, so, right, we're conditioned to be thinking about housing markets in a way that's very metropolitan, because that's where housing academics, policymakers, advocates, and regulators live. But these are very different. Now think of a really low-cost housing, and then think about, to the extent now, Ann laid out all of the reasons why this is particularly risky for buyers, but that has to be traded off to the benefits. What are the transactions costs relative to the price? There are no closing costs, there's no origination fees. Think about that. Those are largely fixed costs, not variable costs with the size. For very low valued housing, it could be completely rational from the buyer's side to engage in one of these contracts. The second feature about these contracts is there's often a lot of relationship capital involved. It can be, a lot of these are transfers of properties between family members and between individuals that you otherwise have a long history with. The reason why so many of these properties are kind of one person properties is they're traditionally rental properties. And somebody owns an owner-occupied house, they own a rental property, and they want to sell the rental property, often to the person who's renting the property. They do it as contract for deed. And so there's some relationship capital. It's kind of a little bit of an omitted variable here. There are, Mark, to your point, there are some reasons why sellers might want to do this. There are some tax advantages of doing this. If you're a rental property owner and you sell this as contract for deed, you can spread your tax liability over time instead of taking a capital gain on the property. And depending on your tax situation, that could be of value to you. Overall, what would be really interesting to do is to do a few calibrations of like, okay, what would the transactions cost be as a fraction of the purchase? And if we could kind of monetize these tax advantages, does it make any sense for these guys to bargain over the surplus and do this in a way that's not a traditional way? And I think that would be really interesting to add. The last thing I'll add about land contracts is we kind of got this. I'm not coming out as an advocate for them, but I do want to say that you kind of get this kind of negative message out of this. And land contracts are a lot like they're a lot like reverse mortgages. They can be used for good, and they can be used for evil, right? And so there are actually not-for-profits in Minnesota, for example, that use land contracts as a way to expand access to homeownership for otherwise underserved consumers. And now they do it in a way that protects a lot of these risks, but they can be used actually in a very positive way. So, but I think it was a really great paper, and I want to see more as you guys progress. Thank you.
Let me get two more questions in the back, and then Laurie.
Hi, Tara Roach from the Pew Charitable Trust. So just a quick question for Ann, and I echo everyone else, more work on this would be great. For the contracts from the Adam data set, do you know if they collected number of signatories? It just made me think as we were chatting about that being a predictor of foreclosure, number of buyers or signatories, if they include that.
Yeah, I'm racking my brain because there's an owner, there are several fields for seller, buyer, and then maybe one agent or something. And I need to check and see mainly if the buyer has more than one name in it, or if that has been, kind of separated out or cleaned so that it's more than one field, owner 1, owner 2. I don't have the answer off the top of my head, I'm sorry. But yes, that could be a piece of the model, a variable in the model to see if that, leads to more instability, if we're able to then track them and see how many end up in forfeiture. Thank you, that's a good idea.
Very quick question for Ann. At the very higher end of the market, you showed a lot of contract for deeds. Could they be seller financing, provided bridge loans where someone had a house that they haven't sold yet, and so you're providing financing on the second house, and it's expected to be a fairly short-lived contract for deed?
I think you're right. So the ones that I looked at, and again, it wasn't like a representative sample. I just wanted to see what was going on because there were such outliers. I mean, some of them were $750,000 properties. They had generally a balloon payment after 3 years or 5 years. So yes, I think that it was a bridge loan that would then probably be converted into a traditional mortgage because, at that point they would need to pay off the remainder and probably have some financing to do that. So you're spot on.
Okay, well, that was a great session. Let's give a hand to the presenters.
We now have an hour for reception, which I believe is right down the hall. So you come out the door, take a left, and head down that way, and there's the classroom for democracy. The David Elwood Democracy Lab. We'll have wine and beer and hors d'oeuvres until 6:30 when we head